All right. So the steps in solving cash flow. Step 1. So let me create the steps. As usual, you start with profit before tax. So that is that. You start with your profit before tax. So let's go. So the name of the company is Deltoid. Then we are doing statement of cash flow. What is the period? For the year ended 31 March 2020. So 3 zeros. 3 zeros. So the first step, what do you do? What's the first step? What did you say is the first step? Yes.
Starts with profits before tax.
So that's all. Come here, profit before tax. So how much is our profit before tax? This is our question 4. What is our profit before tax? And please, you are doing it as at 2020, so focus on 2020. Can you see it? So your first step starts with profit before tax. Can you see it? That is the profit before tax 2020. So where do you find that? That is in the income statement. So fish out for me quickly, please. So I hope you are writing this.
1,800.
And it is negative, right?
Yes,
It's a
negative.
loss. So you write the same thing. So whatever figure that is there, that is what you pick. All right. So you start with that. So you will be the one to solve this question. Question 5. Though I will do it with you, but if you were doing question 5, what would be the figure you will start with? Quick.
379.
All right. So you'll be following these things as we go. All right. Step 2 is to do your adjustments. Now, what we are going to do now, basis this adjustment, is to look up. That's how I call it. Look up. So after you pick your profit before tax, here, this one, start looking upward. All right. Look upward, up to the revenue. And when you are looking up, there are 2 things you are doing. You are going to add back non-cash items. All right, non-cash item. When we say something is not cash, you should know, something like depreciation and all those things. All right. Then you are going to also adjust for non-trading items. Non-trading items. Now, what do we mean by non-trading items? You know your trade, you know trading item. There are certain things that doesn't come because of trading. You should know the features of a P&L. The things that comes from trading ends at operation expenses. It ends at operating expenses. Anything that is not part of your usual operating expenses, if that thing was added, you will subtract. If that thing was subtracted, you will add. So that is it. So you look up from your profit before tax. Just look upward that one. Anything that is not trading item, because trading is sales, less cost of sales, and your operating expenses. Anything that doesn't belong to that area, if that thing was added, you will subtract. If that thing was subtracted, you will add back. And two is non-cash items. So non-cash items includes depreciation, amortization. So you will look out for those things. But for now, look up what is any, do you see any non-trading items? Anything that doesn't belong to trading, anything that is there that is not because of trading, like expenses of distribution, admin, or those things. Those ones, what do you see there that is not trading? What do you see there? That
Please, at which column?
the same place you took the, I said look up where you picked your profit after tax, before tax, sorry.
Uh,
Uh-huh. It should be 2020 because you are doing this thing
Finance
for
cost.
2020. You
Finance
see,
cost.
okay, I'm coming. So this thing is profit before tax. Finance cost. All right. So you adjust, you say finance cost. So what do we do to it? Was it subtracted so that we will add back? Was it added so that we will subtract back?
It was subtracted.
So we will add it back. So how much was that? 1,000.
1,000.
Oh, okay. 1,000. So that is what you do. So if you pick any question, so for this one, if you had picked your 376, the next thing on top is finance cost. It is not a trading item. Please, finance cost is interest. Interest doesn't come when you are trading. Interest come from taking loans and all those things. It is not an operating item. It's not a trading item. So you adjust for that. As for distribution, it's normal. As for admin, it's normal. But this other income, like this, we will adjust for it. What other income is that? Is it another income coming from trading? If it is coming from trading, fine. But if it is not coming from trading, since this one was added, we will subtract. So that is what you do. Cost of sales is from trading. All right. So you look up, you have done that. Then we now need to adjust for non-cash. Non-cash, a typical example of non-cash is depreciation. But you see the depreciation, where will you find it? You should find depreciation. So the following relates to the draft of deltoid. You have this asset, non-current asset, PPE, all right? And you can see your PPE was 25,500. It has reduced. What can cause your PPE to reduce? We are coming to think about them. Inventory, tax, refund due, bank, all right? You have total, your equity side. These are so what will cause your equity to move from 8,000 to 10,000, for example? Yes, any example? Equity. What will happen for it to increase? You know
When you
what?
sell out,
When what?
when you see out shares,
When you issue out shares. Yes, exactly. So these are things you should know. You should know. If your loan, for example, was 5,000 last year, this year it is nil. What does it mean?
It means you have paid, money
You
has
have
left
paid
your
it.
organization.
Good. So those are things we are coming to do. You understand them. All right. So the PPE is here. You have owned the one that you own, you have right of use. All right. So we are looking for depreciation. During the year, debtor sold its leasehold property, blah, blah, blah. There were no additions or disposal. Depreciation charge is into cost of sales. It's inside there. For the year was 1, 2, 3. The total is 3,700. Depreciation is on non-cash. Well, do you see where it is? So you look for depreciation. Depreciation. How much is that? 3,700. So you add back non-cash items. So example, depreciation. All right, depreciation, gains and losses on disposal. Okay, non-cash item. So you know finance cost is one of them. So you can also come across investment income, also like gains. So know that if a gain was added, you will subtract. Okay, so depreciation or amortization or impairment, all those things. So we know that depreciation is 3,700. So we will add back non-cash 3,700. All right. So you are looking for all those things. So now, then on here, there was a bonus issue, and I'll explain bonus issue. 10% loan note is due to be paid. Deltoid is in negotiation with the loan provider to refinance it the same amount for 5 years. Finance cost. See the finance cost. All right. So the total of the finance cost 1,000. That is what we've done. Then we are supposed to prepare the cash flow. Now, after you have looked up and done this, then you will start with your step 3, which is doing your workings. There are 4 workings I will encourage you to do. 4 workings. 1 is on your PPE. Listen, in cash flow, every item you see in the balance sheet, you are going to do a workings for that. So this one, this one, this one, all the items one by one, you are going to do a workings on them. So I group them into 4 major workings that you have to do, sometimes 5, depending on the nature of it. 1 is your PPE. So you ask yourself, you will start with your PPE balance brought down. All right. And the balance brought down of the PPE comes from last year. So that will be 2.5. That is why you'll be needing the old figures. Now you ask yourself, what can cause your PPE to go up? What can it cause you? What can cause it to go up? What can happen for your PPE to go up is number 1, when you add more, is that not it? When you buy more, is that not it?
Yes, please.
What else can cause it to go up? When you do revaluation, is that not it?
Yes, please.
What? So the addition, it can be whether you are buying, and that means there will be cash outflow. All right. Or sometimes whether you are leasing, your asset is via a lease. But these days, lease is right of use. So we do lease for right of use. So the addition can be a lease, or it can be what? A purchase. Or you have your revaluation surplus. So these are the ways your asset can increase. In what ways can your asset decrease? Yes. Depreciation, is that not it?
Yes, please.
What else can cause your asset to decrease?
Disposal.
Disposal.
Disposal. Very good. Good. This is basic cash flow. So it ends here. Disposal. So these are the two ways it can happen. Revaluation too can cause it to go down depending on the revaluation. If you've done all these things, then your figure should be equal to your balance carried down. And the balance carried down is 19,000. So we need to fill in the gaps. We know there is depreciation. Depreciation on the asset is 3,700. We know that one. The question also said they dispose. Didn't they tell us that? They dispose. Deltoid sold his freehold property for 8,500. What was the value of the freehold property itself? What was the carrying amount of the freehold property? The carrying amount. They sold 8 leasehold property. This is the leasehold property. This is how much it was. They sold it. So, and entered into an agreement to rent it back from the purchaser. There were no addition or there were no addition to or disposal of own plants. Okay. If there were no addition, then why has it reduced from here to here? So the breakdown of the asset too is given to us. That's the breakdown of the assets. All right. So the leasehold property, we know that its depreciation is this. So it has moved from this 2,500 to 8,800. So that we know. So we are going to, what you will do is that you will remove the carrying amount of the asset from your books. Please, we dispose carrying amount. We don't dispose cost. We dispose carrying amount. So this is 8,800 and this is its depreciation. So the carrying amount is what we dispose. So the carrying amount will be what? It's 8,800 minus 200. Is that not it? That's the carrying amount you are disposing. So this is the cost, 8,800, and the depreciation for that one. That's the leasehold. So we dispose 8,600. That thing means that if you sell off an asset, the asset cost must leave your books. The accumulated depreciation too must leave your books. So this is it. Is there a revaluation in this question? Do we have anywhere that an asset was revaluated? When we read, we didn't see anything like that, right? So it means here is dash. So the difference, therefore, is our cash flow. It's our cash flow. So what is the difference? And is the difference a purchase or a lease? Because if it is a lease, our workings too will be a lease. And I think this question, there is a lease, right? Finance lease obligation, yeah. So what is the difference? So do your PP, and it is made up of just 1, 2, 3, 4, 5, 6. So 1, 2, 3, 4, 5, 6. The balance brought down, you will see it. Look at the things that can cause it to increase. So additions, revaluations. There is no revaluation in the question because the question will always tell you if there is revaluation. You tell that the asset was revalued, blah, 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 and all those things. But now you don't have it. So they said that he sold and that you have it. Depreciation too, you have it. All right. So what is the difference?
5,800.
It's what? 5,000?
800.
5,800. So this 5,800 can be a lease, which means that they've increased their asset without buying, like paying cash to buy. That is the meaning. Because if you increase it with a lease, then it means that you've not paid any money yet. So there is no cash flow. There's no cash flow. So take note of that. All right. So it means that the balance, therefore, in this our case, because if you check the question, it looks as if there was no addition or in these ones. All right. But there is the question said that when they sold it, they lease back. into an agreement to have one back. So there's this one is from a lease. A lease. That leads you to your, if it is not a lease, you will know. Then that one will be an acquisition. Therefore, it means that you have a cash outflow. But immediately you do workings one, add gain or loss on disposal. And how do you do gain or loss on disposal? It is the proceeds you collect from disposing minus the carrying amount of the asset you disposed. Carrying amount. And that should give you the gain or loss. So, and remember, gain or loss is non-cash. And so you have to go to your operating side of your cash flow, all right, and deal with it. So how much did he collect when he did the sale?
8,500.
8,500. And the cash flow, the carrying amount,
8,600.
8,600. Which means he made a loss, isn't it?
Yes, please.
A loss of
100.
100.
100.
So a loss normally is subtracted in the P&L. So we will add back. So you add back. So we filed our depreciation. So we also have loss on disposal. So these three things, you will see them in your workings one. So you are also adding back 100. So that is that. So if you pick this question, you are going to do. When you pick this one, we know now you are adding back. You find out about this other income. If it is not a trading income, you also subtract it. So you will see the additional information.
Sorry,
Mhm.
please, where did you get the 8,600?
It's cost minus depreciation. Cost minus depreciation. This is the cost of the item. The item that was disposed, this is the cost. And this is its depreciation, leasehold property.
Okay.
I think we used it even when we were doing the. So when you pick this one, you add back this one and the 15,000, subtract it back because it's an income. Income is not a cash flow. It's an income. And here you have depreciation expense for the year. So that is there. There was no purchase of, so, and you work out for this impairment because impairment too is non-cash. All right, you work it out for that. All right. So if there is any asset that was sold, a company also sold one machine, you do it to find the gain or loss on disposal. So do that, okay, so that you'll be getting the figures. So immediately you finish your workings one. So you will be the one to do this question. Even though I will do it with you, I will take your answers and we will be refining it. All right, so that is that. Remember, the proceeds you collected is an inflow. It's a cash inflow. All right, so take note of that. We will deal with it. So you know that cash flow has three arms. We have operating activities, investing activities, financing activities. Now, your operating activities is fished out from your SPL, the operating side, all right, and your current assets. That is where we fish it out from. Investing activities is an investment you made. You fish it out from your non-current assets. Your non-current assets. Financing activity is, so this one is your non-current asset, and the investment side of your P&L, which is finance cost and investment income, that side. Because this one ends at operating profit before interest and tax. Financing will come from your NCL and your equity side. Have you seen that? So this is the clue. This is the clue. Okay. All right. So now we are done with things of the operating, are we not? So let's go to the things of the current assets. So you go to your current asset. How do we know we have done that? You can check that we have done a workings. We have done a workings we have done a workings on our PPE. We are done. We've already done a workings on our PPE. We are done. Internet is unstable. Can you hear me, please? The internet went a little somewhere.
Yes.
So you see, you have done a workings on your PPE. Now you are coming to your current asset. Remember, operating is from the PPE SPL operating side, and you now come to your current assets. So first, make sure you have done everything on the PPE by doing the gain or loss on disposal and the depreciation thing. Now you come to your current assets, and this is not only current asset, it is current asset and current liability. So if you check, your P&L ends with these ones and this. So now you go to your current assets. You pick the first one, inventory. What happened to the inventory? It moved from 4,600 to 12,500. What is the meaning? For your inventory to move from 4,600 to 12,500, what is the meaning? What does it mean?
I think it's
Since you have purchased small goods,
You have purchased more
you have
inventory.
purchased small goods.
Good. And so that one will mean inflow or outflow when you purchase. What will it mean? Inflow or outflow of your cash?
out.
Outflow. So do the difference and put
Okay.
it there. So increase in the inventory means it's an outflow because it means you went to buy some. What is the difference?
7,900.
7,900. All right. I think I need to remove these 00s and bring it here. All right. What is the next thing? Receivables, trade receivables. Now, that one to look at it, it moved from 4,500 to 2,000 to 4,500. What does it mean? If your receivables are increasing, what does it mean to your cash?
Inflow.
No, receivable increasing doesn't mean they are paying you.
Means that
Hetty, think about it carefully.
Okay.
Receivable means what? Those who buy from you on what?
credit.
On credit.
Credit.
So it doesn't mean you are getting money.
Mm.
So if it rather reduced, what would it have meant?
Means that you have received cash from
Inflow.
people.
Good. Now that it has increased, it should tell you that there's a problem. Your money is going to the credit, the receivables. That's where your money is. So it also, when it is increasing, it is an outflow. Think about it. Don't rush it, okay?
Okay.
Carefully think about it. So if my receivables are increasing, it means all my money are going to some people. But if your receivables are decreasing, it means they are paying you back. You are getting the cash. All right. So what is the difference? That's 2,500, right?
Yes, please.
Good. Come to the next one. I told you that it is the current asset and what? The current
Liability.
liabilities. So you go to your trade payable, current liabilities. Where is your trade payable? It is all about your operating. Trade payable it was 4,200. Now it has gotten to 4,700. Is it inflow or outflow? Think carefully and answer that.
It's
What
an
does it mean?
outflow.
It's an
It's
outflow.
outflow.
What makes you say it's an outflow?
Your
Because
owings to has increased.
But have you paid? Listen, it's cash
No.
flow. Cash flow. What we are
Um,
doing is cash flow. That's why I said think about it well before you answer. The fact that the thing increased doesn't mean that you have given, like you've given cash or you received cash. That is what cash flow is about. It's not about accrual. It's as to is there cash inflow or there is cash outflow. That is what cash flow is about. So if your payables are increasing, does it mean cash left you?
it means you are taking more goods from your suppliers.
No, we are talking
your
about cash.
cash
You are
didn't
also
leave.
talking about goods. Does
Okay.
it mean that has cash left you? Or
No.
so if it is not an inflow, then it is an outflow. If it is not an outflow, then it's
Outflow.
an inflow. So your payables, if it reduced, what would you have said? If your payable
Outflow.
reduce, outflow. So that is it.
Yes.
So if it goes up, then it is what?
Inflow.
So think about it in respect of your cash. Don't just say something has increased, so that means that it is an outflow. No, think about it in respect of your cash. If it had reduced, then you know that you paid something. Is that not it? If your payable reduced, doesn't it means you paid?
Yes.
And paying means it's an outflow. So that's how you are supposed to analyze it. Is that okay? Now,
Mm.
when you do up to this point, you do your inventory, receivable, and payable, you can total everything. So first do the lookup, do those ones, look for the gain or loss on disposal to come and work on them, and depreciation. If there is impairment, come and do impairment. Impairment, depreciation, amortization, they are in the same bracket. So go and look for those ones and so. Then do your workings one to know whether there is a gain or loss on disposal and come and also bring it in. If it was a gain, gains are added to P&L. And so when we are working on it, we will subtract it back. Loss are subtracted. So when we are working on it, we will add back. That's how you work it. So do the total for me. What would you have?
Negative 6,900.
Negative what?
6,900.
So you write it negative 6,900. That's fine. Now we go and do our workings 2 and workings 3 and you come back. We will be doing maximum 5 workings or 4. Usually I advise students to do 4 for level 2 cash flow. All right. So we are going to do our workings 2. Now the workings 2 is on the lease. If they did lease, the workings 2 will be about lease. If they didn't do lease, our workings 2 will be about just our taxes and interest. So workings 2. So because our addition was via a lease, we need to do lease. So lease liability brought down. Now, what will cause our lease to increase? Our lease will only increase if we do another lease. That is it. You increase your lease if you do another lease. So is there a new lease? And your lease will come down if you pay the lease. If you pay on the lease, so lease payment, then you should be getting your balance carried down. So the balances, look at the NCL side and the CL side. So put it together. So look at the NCL side plus the CL side. NCL side, CL side. Because if you know how lease is done, you realize that in every lease, some amounts go to your NCL and some amount also go to your CL. Is that not it? So
Yes.
look at those places and get your balance. So when we look at our lease, this is our NCL side, there is lease obligation. The balance brought down is 2,000. Our CL side too, there is lease obligation is 800. So the two should give us 2,800. Is that not it? So 2,800. So the two is 2,800. They are all from lease. Now, was there a new lease? Yes, that is what you had here. A new lease. Because according to the question, when they sold, they lease it back. They did some. So there was a lease, a new lease. We entered into an agreement to rent it back, and that is lease. So when we found that our addition was also via a lease. So from our workings one, we know that there is an additional lease of 5,800. For the payment, we need to look for it. That will be the difference. And the balance is our 2020 balance carried down. So where is it? We have a lease here, 4,800, another one, 1,700. That makes it what? 5,500, right? Or 6,500.
6,500.
6,500. So how much have they paid such that this thing has gotten down? How much has they paid? So that is how you find the cash outflow. All right. If the addition was not a lease, we wouldn't be doing lease, the lease working. Straight, we would have said that the purchase was via cash. And so therefore, we would have left it there. Workings 3 is about interest and tax. So get me the answer. Interest and tax.
2,100.
2,100. So it means that when we get to our investing activity, or you can call this a financing activity or investing activity, whichever one you put it there, but you can put it as investing activity. So when we do investing activity, we are done with the operating activities. The operating activities ends with interest and tax. So let's do interest and tax. That one too, you need balance brought down of interest. That is your finance cost. Interest in accounting is called finance cost. So guys, don't be confused. And where will you find in balance brought down of finance cost? It is in your current liabilities. Remember when we're doing the publications, anytime we have finance cost, we go to our current liability. So go to your current liability and check if there is anything like that. It will increase by something in the P&L, any finance cost in the P&L, and it will decrease by paying. So that is it. Tax 2, you should check your balance brought down. Remember, tax is made up of CT and DT. So go and look for your CTs and DT and add them. Then tax will increase by the one that is in your P&L, and it will decrease by you payment. Then you also get your balance carried down. So let's look at the finance cost. The finance cost. Do we have any balance on finance cost liability? No. No, 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 no. So we don't
What
have
of the
any.
interest on the loan?
Where is that? Where is the interest on the loan?
10% loan
Oh,
notes.
that is not interest.
Oh,
It's the
okay.
loan note.
Okay.
If that is an interest, if they wrote interest, this is 10% loan note. That is the loan note. That is not an interest. Anyway, let's go to note
Okay.
3. They've said something about it. It says that the 10% loan note is due for repayment in 2020. Deltoid is in negotiation to do a refinancing for that. No. So it's not there. That is the loan. It is not what we see in the balance sheet. This one is not interest. If it was interest, they would have
Okay.
written interest, but that is actually the loan. So we don't have
Okay.
a balance. In the P&L, do you have finance cost interest? Where's our P&L? Have you seen the interest?
1,000.
1,000. That
Finance
is,
cost.
yeah, that is your interest for the year. 1,000. All right. So I think it is the interest we added back. Is that not it?
Yes.
Hmm. Yeah. So was this interest paid? Do you have a balance carry down of interest? You don't.
600 from
That is a P&L
that
item.
portfolio.
So,
Ah,
that means that it's a good thing you have made that mistake. Please, P&L figures is not balance brought down. Do you know why we call the balance sheet the balance sheet? Have you thought of it? Because it holds balances,
yeah.
balance brought
Ah,
down and balances. That's why we call it a balance sheet. So all balances go there. That's why we call it balance sheet. When you see an interest in a P&L like this, it means it's an accrued interest or a paid interest. So unless you get an additional information on it, if it is not a paid interest, you will also see that same interest in your liability. Okay, if that interest is
okay.
not paid, you will also see it in your liability. That's why we went to check the liability side. But if you see an interest here and you don't see it in your liabilities, what does it mean? It means that is what you paid and you have paid it last year. It's gone. We are doing 2020. So for we not to also see any balance of 1,000 in our current liability means that this interest too was paid. That's the meaning. So please, these things don't represent in the P&L. Last year figures are not balances. They are paid or earned or accrued figures. So it's a good thing you brought this thing up. So please, balance sheet, P&L figures are not balances. All right. I hope you will remember that. Then, so you won't say this is revenue brought down. No, 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 no. It's revenue earned or revenue received. That is it. It has nothing to do with balance. So when you want balance brought down, balance carried down, please, they are only in your balance sheet. Is that okay?
Okay. Thank
All
you.
right. Good. It's good. So it means this is what was paid. So interest and tax. Tax. So working straight. We will also do for tax. So the interest is 1,000. And when you pay an interest, is an outflow. As for this one, that is how it will be. All right. So that is that. Now, the next thing is to do your tax. The tax tool, let's check the balances. Go to the balance sheet. So if you are following carefully, you realize that we have done this and the trade. So we are on to tax now. So tax, go to your NCL or your CL or sometimes your CA and your NCA, because if you remember the last publication we did, there was a tax refund in our current asset. So if you look at the tax, deferred taxes here, balance brought down is 800 as a liability. There's nothing on top here. So, and there's another 2,500 here, tax, right? So when you add up, what do you have? The two give you like, is it 3,300? 3,300, eh?
Yes.
Good, good. How much tax is in your SPL? Go to your SPL. What is our SPL? Income tax is an income tax. If it is in brackets,
Relief.
they say it's an expense. This is it. And please, you are looking at only the current year, P&L, current year. Don't look at last year, current year. And I see 700. The 700 is a positive. So it's a tax asset. So I put it into brackets. If it was an expense, I wouldn't have put it into bracket. It would have mean that our liabilities are increasing because you have an additional tax. This is a liability. So for this to be a positive, it means it's a tax asset. It means we are reducing so it is a tax relief. It is not a tax expense. All right. We will look out for the payment. We will calculate it very soon. So let's go to the balance carry down. How much do we have in let's check. There was also a tax. Okay, here was nil. So in this year, the tax is nil here for this one, but there is deferred tax of 1,002. And there is, I'm going to do minus because it is a tax asset. It's a tax asset. Minus 500. It is not a liability. So that's 700 positive here. So how much tax did we pay? How much tax did we pay? So that our balance is 700. Is how much?
3,300. Oh.
Are you sure? Are you punching calculator or you have seen 700 here and 700 here, so the difference is this? Do you realize this 700 is in bracket?
2,600.
Are you sure? Because you did the first one, I don't trust it again.
Oh,
3,300 minus
3,000.
700 is
Mm.
2,600. But how will it get to
Actually,
700? It's 1,009.
1,009.
Yeah, you will need 1,009 to let your balance get to this. And that is your tax paid.
Mm. Mm.
So if you put the 2,600 here, you will get 7,700. So don't underestimate it. Let your calculator work for you. All right. Now, so tax paid is 1,900. 1,900. So that is how you do it. Now you can close it out. You are done with operating activities. What would you have? So net cash flow from operating activities. So what would you have? 1, 2, 3. It's increasing it. So 7,800. And when this one adds up, that's like 9,800. Is that not it? Negative. The good news about cash flow is that the answer is in the question. the answer is in the question. Your answer is your bank and cash. So the answer should be in the question. So if you get it wrong, you will know. So let's come to investing activities. We said for investing activities, which areas should we be looking at? The NCA, right? Changes in the
Yes.
NCA. Okay,
Yes.
but we've done it already. We've done the NCA already, and we saw that there was proceeds from sale. This is it. There were proceeds from sale. And we also paid a lease. So that is what you will see there. So all that you say is proceeds from sale, proceeds from disposal, proceeds from disposal. We collected how much? 8,500, right? When we sold,
Yes.
and it is cash inflow, 8,500. And we also paid lease payments, 2,100. So this is it. So that place is the easiest part. Is the easiest part. When we finish, I will show you the template for a cash flow. Like it's a template, but now, even though you've not done it before, you've seen the processes. All right, you are seeing the processes. So lease payment. So that is that. All right. So if you check, we have done this workings on this tax already. We don't touch the cash and bank because that's where our final answer will come from. All right. So, and we have also
Right.
touched on these ones, the finance lease, the deferred tax. We've touched on those ones too. So it's left with a few to go. So let's go to our financing activities, and that will make us do our last workings. Financing activities. It starts with stated capital activities. So we said financing activities is from your NCL and equity. All right. So let's start with the equity side first. The equity side, this is our equity side. We have equity shares. Equity shares. And we said that for this one to increase, it means that we issue shares. And when you issue shares, people give you money. So look at that side. There's a note to it. Indeed, we were told that they did a bonus issue. And please, in the example we did earlier, there was a right issue. And this one too, there's a bonus issue. I explained to you that right issue is when you issue shares to your own shareholders at a price below the market value. But bonus issue is when you issue shares to your own shareholders free of charge, which means that they won't pay you. They won't pay you anything. They won't pay you. So who will pay? You, the entity, you pay it yourself. You pay it using your share premium. The entity pays it itself using its share premium. So how many number of shares is the company having? You can always see that in from the equity side. 8,000 at one means that they had 8,000 shares. All right. And for this one to come means that they brought in, they collected some money, i.e. there was some money in the equity, so something came in. So between 8,000, where is it? 8,000 and 10,000, it means something came up. And between 4,000 and 3,200, it means the entity has rather spent. So that is it, share premium. All right. And I told you that anytime you do bonus issue, who pays it? Who
The
pays it?
entity pays
The
from
entity
their
pays
share
it.
premium.
Yes, from their share premium. So clearly you can see that the entity has paid from their share premium. That's why the share premium has reduced. The share premium has reduced. So whilst the entity was collecting 2,000 from the issue of shares, as you can see, from 8,000, it moved from 8,000 to 10,000. It means they've collected money. The share premium also communicates that they lost money. It also moved from 4,000. It went to 3,200, meaning that they paid it themselves. It's an outflow in there. That is 800. So that is what you see there. It's an outflow. So that is for the share premium and that. Then the retained earnings, that is our workings for. Now you ask yourself, workings on retained earnings. Your retained earnings increase when you get profits. If you saw in the publication, anytime we get profit, we add it to our opening retained earnings. Then we get our closing. But retained earnings reduces when you pay dividends. Dividend is paid out of retained earnings. So let's see, what was our balance brought down for retained earnings? Balance brought down retained earnings, 6,300.
300.
It will increase by our net profit, like we learned in publication. And the net profit, where is it? This is it. Profit for the year or loss for the year. This is a loss. So 1,001 is a loss. But it will decrease further if we pay dividends. So let's see if there was dividend payments and we have our balance carried down. So what is the balance carried down on the retained earnings? Retained earnings, that is 4,500. So clearly you can see that they pay dividends. So how much did they pay as dividend? How much did they pay as dividend? Use your calculator and give me the answer.
700.
700. They pay dividends of 700 then. Okay, so that is that. You go to your cash flow. So dividend payments. 700. So that is the equity side is done. Now let's go to our loan side, the NCL side. The NCL side. So if you've been taken, we've used our trade receivable finance list. The bank, I said you don't touch it. We've touched tax. So we are left with the loan. The loan, you started with the loan of, we didn't have a loan here, but the loan is here, 5,000. At the end of the year, you are still having a loan of 5,000. That means that you have neither paid or gone for additional loan. Is that not it? The loan note is 5,000, it's still 5,000 at the end of the year. So it means that you have neither paid nor gone for any additional loan. But this finance list, you have done the workings on that. Deferred tax, you have done. So basically, you've done all the workings on all the items. So let's close out the investing activity. Let's bring it here. So close it out. And close this one too out. This one is 1,005, right? So it means you have 500 positive. But what about this one? Positive, what is that? 8,500 minus 2,100.
6,400.
6,400. Good. So add the 3. So please, at the end of the day, use your pen to tick every item that you've done something on it. You've utilized it. That's how you know you are getting close to a correct answer. So this figure is called net investing cash flow. Net cash flow from investing activities. This one is called net cash flow from financing activity. So what is the total from the three? That's 7,100. 7,100. Hey, sorry,
A loss
6,000.
of 2,900.
The difference is what?
A loss of 2,900.
This, and this. A loss of
2,900.
2,900. All right. So now, after you have done this, you are coming to add your cash and bank balance brought down. When you add it, your answer should be equal to the cash and bank balance carry down. So your cash and bank balance carry down is the answer. If you don't get it after you've added your cash and bank balance brought down, then it means your cash flow is a problem. So the answer is always on the cash and bank side of your balance sheet. If we add this, the cash and bank balance brought down, it should automatically be equal to the cash and bank balance carried down. If it is not, it means we've made a mistake somewhere. So look at it. What is your cash and bank balance brought down? So go to your bank and cash. This is bank. Balance brought down here is 1,005. You don't have the balance carried down should be your answer. So the balance brought down here, you have 1,005. So if we add the 1,005, the answer we get, what is the answer? It should be equal to our, and where is the other bank? Here is nil, so it means it should be somewhere in overdraft. Yeah, this is 1,004. So do you get 1,004? Negative 1,004?
Yes, please.
Good.
Negative 1,000.
Good. So that is it. And that is your balancing figure. So if you don't get that, it means you are wrong. All right. So your cash flow has balance. So you are going to, and I want you to do this thing, send me your answer. We will definitely do it together. I want you to do it and get me your answer. Now, in this question, this is your answer. Go to your bank and cash. So this is bank and cash. There is no overdraft. So these two figures, if you are correct, you have cash of 16,712 and a bank of 304,437. If you look at it well, so 1, 2, 3, 4. 1, 2, 3, 4. Yeah. So get me the total. When you do it, that should be your final answer. If you don't get that one, it means you didn't do something right. So get me the answer so that you will write it down. And you go and try it. Remember, depreciation is there, impairment is there. So use the notes. The notes. And remember all these things. Effective rate, the IFRS 9 financial instrument, effective rate goes to P&L. That is your interest. So if you are doing your workings on interest or finance cost, that's where you can find it. So do the adjustments and find the figures. I will meet you at a communicated time to find it. So what is the answer? 16,712 plus 304,437. That is
3211.
321149. So go and try it. If you don't get 321149, it means that you couldn't balance it. But at least the exams, even though you are not able to balance some things, you should be able to get most of the things right. So that is what will happen. So that is that. So I assume we've done 5 questions. There's a fifth one. You are the one going to do it. We will meet again to do the console and the ratios. By that time, we might have met to do the standards. The standards, we are starting on the 19th. So check it. All right. I'll communicate to you the day I will do the standard, the CR intervention time. The day we will be doing the standards, I will let you know. All right. So thank you very much